Good afternoon, everybody, and warm welcome to all of you. I extend my welcome to Professor Sushanta Mallick, Professor of International Finance in Mary University of London. Today we will speak on foreign financing and fund performance. Before starting his talk, may I request Dr. Gagori Chakraborty of our department to introduce Professor Mallick to all of us.
Thank you, Moushumidi. So today we have the pleasure of having Professor Sushanta Mallick with us. He will be talking on the topic, does easing access to foreign financing matter for farm performance? Sushanta Mallick currently works as a professor of international finance at the School of Business and Management, Queen Mary University of London. He received his PhD from the University of Warwick. He does research in financial economics, development economics, and applied econometrics. His ongoing and published research crosses the boundaries between international economics, business finance, and development studies. He has widely published his papers in highly reputed journals. He is currently the co-editor-in-chief of the journal Economic Modeling. So now it's over to Professor Mallick. So we shall be taking the questions after the session. And in the meantime, if anyone has any questions, then he or she is welcome to write in the chat box. So over to Professor Mallick.
Thank you very much. First of all, I would like to thank the department and Professor Moushumidi for inviting me to give this lecture. Of course, this paper is a joint research with two of my colleagues, Udici and Seraphim. This paper is already published, as you can see here in Journal of Corporate Finance. It's coming out, this next month, October. And so I thought it would be, although it's a finished paper, however, I would still welcome comments if we were to do any future research on this topic. However, it would be difficult to incorporate any comment on this particular since it's already published. So this, of course, I thought it would be of interest to people here because it relates to India. And it focuses on a general problem that many developing and emerging market economies have. I'll come to that a little later. So the idea is to see when you have a flexible capital account, in how does it benefit firms, those who are engaged in international transactions. So here, obviously, we are looking at exporting type of transactions. And so the key problem that we always encounter is that firms tend to be constrained with regard to access to financing. And it is particularly so when firms are engaged in international transactions, like exporting firms or firms, those who have to import technology from outside, inputs from outside. So they need to have access to foreign currency. And so this lack of access is a big constraint for firms in many emerging market economies. And we have seen since the early 90s, we have seen many countries have liberalized their capital account transactions. And you will find many papers where people have looked at the effect of these capital account liberalizations on cross-country performance, okay, in terms of economic growth and so on. And I'll show you a little later, comparing different countries, about the level of financial openness, I mean external financial openness or capital account openness. And so the whole idea is to enable firms to get better access to financing. But in this paper, instead of looking at this cross-country capital account liberalization, you will find many papers on that. Capital account liberalization and effect on country-level growth. But what we are doing here is we are evaluating one specific type of financial openness intervention. Okay, so this is something which one can do. One can evaluate its effect at firm level. And because, of course, there are many types of interventions could be taking place at country level. And if you want to look at, of course, obviously it will affect all firms in a similar way, right? So if we have to try to see the firms which benefit and firms which don't benefit from a particular type of financial openness intervention, we are looking at the case of India because it really gives us a clear kind of case where we could actually examine a policy intervention that took place in 2000. I'll discuss that a little later. So this policy intervention can allow us to show whether easing financial capital controls can be beneficial for firms. So in other words, what we show here is that firms with better access to foreign financing are more likely to improve their productivity. How they will improve? They could improve their productivity by investing in high-skilled workers or by adopting new technology or creating better and higher quality products and so on. So to begin with, I'll try to keep the discussion only with reference to productivity improvement, and subsequently I'll look at the other channels as to by replacing productivity with other channels to show how this liberalization or financial openness is helping those firms to improve access to financing and thereby improving their productivity and export intensity later on. So what we know from the literature that firm heterogeneity and entry cost, of course, firms are heterogeneous, and therefore those who can overcome their entry cost successfully would become successful exporters. So there is this literature has emphasized these two dimensions. Heterogeneous firm trade literature emerged in last 20 years ago. And so clearly there is a lot of empirical research on this topic. And we also know that in the presence of financial market imperfections, only those firms that can successfully overcome this financing of entry cost could become exporters. And we've also known from evidence that firms which are financially healthy have better access to external finance, and they are more likely to start exporting. But this access to trade finance is costly, and it is limited in the context of many developing countries, although they have the potential for trade expansion. So before I go, let me just make this, let's look at this aggregate index of financial openness. This is due to Chi-NATO, which I think everybody is familiar with this. And so we can see here, I'm just comparing some of these emerging market economies with the two advanced economies. US is this the vertical line at the top, and then this is UK. So you can see greater the number, higher is the degree of financial openness. That's what the index tells you. And you can see some of these emerging economies like BRICS here I have put together. Brazil, Russia, India, China, and South Africa. You can see they have capital controls. They're not fully open, right? So particularly we can, it's important to look at this China and India, this green and black line. Okay, so pretty much they have closed capital account, although they have a fully flexible current account. They have controls on the capital account. Therefore, firms in say China and India will be constrained to borrow from overseas if they wish to. Okay, so that's the policy that we will be looking at in the context of India. Okay, so China has the same story, but here we are not only focusing on India. There is another incentive also for Indian firms. They would obviously, any firm, they would borrow from a country where it's cheaper, right? So they would borrow if borrowing in dollar is cheaper, they would obviously borrow from that. But if they're not allowed to borrow in foreign currency, like the way it is in China and India, so they will be constrained, right? So here we have, I'm just I have plotted it here. This orange color is the Indian interest rate, and the blue one is US interest rate. So when you can see US interest rate is just around 3%, Indian interest rate is around 9%, right? So you have the 6% interest rate differential, that if you are borrowing in domestic currency, that's the amount you would pay in order to borrow money. Whereas if you borrow in dollar, because your income is in dollar or in a foreign currency, you would obviously prefer to borrow overseas, which is cheaper. And sometimes it's easier to pay back also, rather than converting money from dollar, and then you have a problem of rupee weakness and so on. So this actually clearly tells you that firms would be interested in borrowing in dollar or in a foreign currency, which are available at a lower rate relative to their home currency. Okay. So, but they are constrained. They cannot borrow overseas as much as they want. So this is why this policy, this is called the Foreign Exchange Management Act, which came into being in 1999, replacing the earlier system, which was called Foreign Exchange Regulation Act, FERA, 1973. And so one would think this is clearly a policy shift, right, from one FERA to FEMA. And there is a lot of writing on this. You would see many papers, including Patnaik 2015. They summarize all the regulations surrounding this. And so one thing I want to point out here is that initially when this Management Act came into being, they allowed Indian exporters to borrow to the extent of 50 million US dollar. Okay, so that was the limit which was initially fixed in 2000, but subsequently this limit has been relaxed from 50 million US dollar to, every year they have been relaxing this amount to enable firms to borrow in foreign currency a bigger amount, depending on the size of the firm and so on, or depending on the industry in which they're operating. There could be need for borrowing money to import technology and so on, particularly in the manufacturing sector. So this limit has been relaxed over time. So currently that limit is around 750 million US dollars. So that's the maximum amount that firms can borrow from international debt market. Okay. Now this, of course, for bigger firms, big size firms, they might require more money, not just 750, maybe more. What they have to do, they have to apply to RBI in order to seek approval, if they need more funds in foreign currency and so on. So, but still, many firms would be able to meet their requirement because they're able to borrow in foreign currency now. They can go through automatic route. There are two routes, automatic route and approval route. So they could go and borrow this, and this would help ease their external financial constraint, which they might be experiencing. So obviously you would expect this would have some impact on these firms who are able to borrow. Now what does it do? So such capital account liberalization or firms with the better debt market access, are they able to increase their export intensity? So I'm thinking in terms of intensive margin, not so much extensive margin. In this paper, we are focusing only on the trade intensity or export market intensity. So let's just look at this extensive margin that also shows a significant improvement since 2000. You can see here on the left-hand side. The number of exporting firms has increased significantly since this policy came into being in 2000. And you can see firms are also able to borrow. The ECB amount is 6 times bigger than what it was before 2000. And even the borrowing amount has significantly increased. It was before FEMA came into being, it was around $6 million. Probably some of the big firms were able to borrow with approval from the RBI. And afterwards, they didn't require this approval from RBI, but the average amount is around 40 million US dollars. And there is also another limit that in any particular year, the total amount that firms can borrow in India should not exceed 40 billion US dollar. That's the maximum. So if that amount, it goes beyond that, obviously, the central bank would come in and stop any further borrowing. Okay. So, and that is clearly statistically significant if you look at the mean difference between these amounts before and after FEMA. On the right-hand side, you can see here that even out of the total number of firms borrowing, so big part of those firms, a big part actually are exporting firms. You can see here, right? So most of them are exporting. There are some still non-exporting, but probably they are still borrowing. This ECB is external commercial borrowing. FCB is foreign currency borrowing, which is a broader concept, FCB, than ECB, which is somewhat narrow. And so I'm going to use this word FCB all the time, foreign currency borrowing, which includes all types of foreign currencies, not just dollar, could be euro and other currencies as well. So clearly one could see that mainly among all these firms, the majority are exporting firms, right? So our main goal here is that, main hypothesis is to see whether these firms, so when I use the word treated firms here, my focus is only on firms, those who have borrowed in foreign currencies, okay? Those who have some kind of foreign currency borrowing. And so it takes value 1 when they have that borrowing is positive, okay? And otherwise 0, so that would be our control group. So among those treated firms, those who have had access to or used this borrowing, foreign currency borrowing, whether those firms were able to increase their productivity, have they become more productive relative to firms, those who did not use foreign borrowing, rather they relied on domestic sources of financing, okay? And this is our first stage. So first stage, we look at what happens to the firm's productivity, okay? In other words, performance. If they have become productive, then you would ask, were they able to increase their exporting intensity? That's the second stage, okay? So that's how, because we know, if we look at, there is a huge literature on, empirical literature on export premium, self-selection, learning by exporting, and these hypotheses, they are there in this trade literature. So the idea is, we know that most productive firms tend to be exporters. Firms which are productive today, they tend to self-select themselves into exporting next year. So it has been well established. It's in another paper of mine, which is published in the 2013 Review of International Economics, uses same firm level data from India, Prowess data, which is the only source that we use to deal with the firm level analysis. And also, even after they enter into exporting, you also find evidence that whether that productivity has increased after they enter into exporting activity. So you clearly know productivity is the channel through which you can become an exporter, or you can increase your your exporting intensity. Okay, so that's why productivity is the channel that we use to show how they are becoming, how they are able to benefit from this policy, and to be able to increase their intensive margin, okay, export intensity. And now then, that is like our first hypothesis. And second, we try to look at the heterogeneity of firms, because there are different categories of firms. All firms are not alike. So there are firms who are heavily dependent on borrowing. There are firms that don't, right? So whether if a firm is not using debt financing, really this policy has nothing to do with them. So we try to look at the debt dependence of those firms. Are they heavily dependent on debt financing? If so, then So if they are heavily dependent on debt financing, then we should consider them, how they are affected by this policy shift, right? Similarly, there are also firms that are constrained. In what way? Constrained means they don't have enough cash. They are less liquid. So they're liquidity constrained. So if that is the case, then you would expect those firms to benefit from this policy, because it allows them access to borrowing from overseas. Therefore, they can become successful exporters and increase their export intensity. So what we do is either we look at the top 25% of the debt dependence. We take debt information for all firms, look at whether they are in the top 25% of their debt distribution. So those firms will be categorized as heavily debt dependent firms. In other words, they use foreign borrowing. And similarly, we use bottom 25% of liquidity distribution. Okay, so then we said they are liquidity constrained. They don't have enough cash, enough liquidity with them. So you would expect them to benefit significantly from this access to foreign borrowing. So therefore, our second hypothesis is, following this policy initiative, whether financially vulnerable firms, we call it, when we use the word vulnerable, either they are heavily dependent on debt, that means they don't have any more capacity to borrow, right? They have no more slack in their debt capacity. Therefore, this access would enable them to be able to borrow in foreign currency, and therefore they could do something with that money, right? If they're exporting, they would invest in technology, invest in hiring workers, and so on, designing better products, and so on. So, and second, we look at also vulnerability in the context of their liquidity. Are they liquidity constrained or not? If so, probably they would stay in the bottom 25% of the liquidity distribution. And then we try to look at, so this is like we look at a triple interaction here. We have the same thing as we do in hypothesis 1, but in addition, we try to distinguish between this debt using firms, heavily debt using firms, and liquidity constrained firms, which we call them financially vulnerable firms. Okay, so we expect them to be benefiting from this additional access. So the first thing, before we do this analysis, first thing we have to do is try to satisfy this parallel trend. We have these two categories of firms which are using foreign borrowing, okay, that is our treated firm, that's our treated group, and firms which are not using foreign borrowing, that's the control group, right? So you would expect these two categories of firms. This top one is the treated and the bottom one is here, the flat one is the control group. So you would expect the both categories of firms to behave in a similar way in the absence of the policy intervention. Okay, if the policy intervention did not take place, they had a similar trend, common trend, or which we call parallel trends before this intervention took place, right? Clearly, you can see there is a productivity difference after the intervention, after the treatment. So now, second, we can also look at not only the productivity difference between the two categories of two types of firms, but also the export intensity or export share between these two categories of firms. So you see that before 2000, before FEMA came into being, they had a similar trend. Both types of firms, both treatment and control group had similar trend, and which is becoming visible. The difference is becoming more clear after this policy came into being. Okay, we'll do a lot of tests to check this, but I'll come to that little later. So the data, which I think many of you are familiar, and this is the Prowess data set, and we have around 11,600 Indian firms over this time period, 88 to 2014. Okay, that includes all kinds of firms. Now the model we estimate, it's a kind of two-stage estimation. Okay, so the first stage, we are using total factor, we are estimating total factor productivity, and we are, because that's the channel we want to explore, right? So we want to show whether this FEMA is the treatment here, and FEMA is the policy shift which took place is basically is capturing the temporal variation. And so the treatment here is those who are using ECB or FCB, foreign currency borrowing, and those who are not using, that's the control group. Okay, so this among the firms, those who are using treatment, using foreign currency borrowing, and whether those firms have benefited from this policy shift which took place in 2000. So, so clearly this policy will influence those firms who rely on foreign borrowing. Okay, others will have, of course, obviously you wouldn't expect any impact. So first thing you would expect among those firms, whether they are more productive because of this policy change, right? So alpha 1 is the DID, the difference in differences coefficient, right? So you would expect alpha 1 to be positive and significant if you want to show that these firms have become more productive after FEMA came into being, right? Now, once then what we do, we take this product, the TFP, predicted values of this TFP from the first stage. We have all kinds of controls. We have this gamma I, which is the firm fixed effect, time fixed effect. We have here this delta, that is the industry fixed effect, and theta, that is a state fixed effect. Okay, and we have, in doing all that, we estimate what is the TFP at firm level, and that TFP then entered in the second stage. Okay, TFP, the predicted values from the first stage enters the second stage. And then we estimate whether FEMA has led to an increase in export intensity. Okay, now there is another empirical challenge here. How do we, because this TFP can take any value, right? It's a log TFP that can, it's not bounded between 0 and 1, whereas export intensity is bounded between 0 and 1. It has a lower limit 0, upper limit 1, right? So you need an estimator that can help us to estimate it in a more efficient manner, right? So this estimator we are using is known as is doubly censored Tobit estimator. Okay, this because it's first thing is we need the dependent variable is a fraction bounded between 0 and 1. Second, it makes it difficult to have even here now firm fixed effect in a Tobit estimator or any fractional estimator. It is difficult to have a firm fixed effect. So therefore, what we do here is the CI you see here, CI, that is basically capturing this firm fixed effect, and it is modeled as a time average of all control variables. So for each year, for all firms, you will have the same value. Okay, so it's a time average for each year across firms. Okay, CI. So that is used as a firm fixed effect. Then other fixed effects are fine, time and so on. Right. So this alpha 1 is that DID DID coefficient which would be of our interest. Okay, and now, as I mentioned, this is the paper which gives us this estimator, doubly censored, doubly censored because you have both lower limit as well as upper limit. Okay, and also there is another problem that we have to take into account is the simultaneity. So we take that, so we lag. So the dynamics becomes even more difficult with this kind of estimator, fractional estimator. So therefore, we have used Tobit only for that reason because it allows to include dynamics in the estimation. So all time varying firm level variables, they are lagged by 1 period, okay, to reduce the simultaneity bias. And we also, one would also raise a question as to, well, we are still not using a estimator that can take care of this dynamics. So for that, we use GMM at the end as a robustness, okay? So we use Tobit. So basically, we have these two equations I showed here. The first equation is estimated by OLS, fixed effect. And the second one is estimated by export intensity, is a Tobit estimator, right? And now this is our first stage. Second stage is about heterogeneity. That there are two types of heterogeneity we consider here. One is with regard to debt distribution. We are separating firms, those who are heavily dependent on borrowing and those who are not, meaning they must be at the top 25% of the distribution of debt. We call them financially vulnerable because they would not access to debt market, right? Therefore, this policy would help them. They would be able to borrow, even if they are excessively debt dependent. Similarly, those who are liquidity constrained, they're at the bottom 25% of the distribution of liquidity, and therefore they would benefit from this policy, right? So we consider these two levels of heterogeneity and bring in another interaction. Okay, so this DID you had, now it's basically triple D effect. This alpha 1 coefficient will reflect that 3D effect. right? And the other things remain the same. The estimation methodology remains the same. Now, let me quickly run through this. This is quite straightforward. Summary statistics. We see that export share, or which I call intensity, has increased significantly for firms those who rely on external commercial borrowing. And firms with access to external borrowing, they tend to be financially healthier. They are also more productive, as you will see here, relative to the domestic firms. This is the FEMA. This means before 2000. This is after 2000. And then the groups, the treatment group is the group which which relies on foreign borrowing or which uses foreign borrowing, and control group who don't use foreign borrowing, right? So you can clearly see the ones who, since FEMA came into being, you will see firms, those who use foreign borrowing, they have become more productive relative to this number here. They have a higher export intensity. They're bigger size firms. They pay higher wages. They tend to have debt dependence, and they are also liquidity constrained. So you can see on average, that's the coefficient, that's the average value of liquidity. So now we, as I mentioned earlier, our difference in difference coefficient is this treatment times FEMA. That's the DD coefficient. It captures the effect of the policy on the treated firms compared to control firm. And we show that firms with access to foreign currency borrowing, they are able to improve their productivity, and thereby their exporting intensity compared to firms with access to domestic borrowing only. Okay, sorry. So the treated firms increased productivity by 15.5 percentage points after this policy reform came into being. And among those firms, if they experience an increase in TFP, that contributes to increase in export intensity as well. And we can see here, this is our baseline model. And treatment FEMA interaction is statistically significant. So the first panel here on the top, this is the TFP regression. I said the first model. And the second one here, the bottom panel, panel B, is the exporting model. So these two models are estimated here separately. And we can see that DD coefficient is statistically significant in both the first panel A as well as in panel B. Okay, so in panel B, as you can see, as I mentioned earlier, that TFP is the channel through which FEMA is being reflected. Okay, so in the first, FEMA is enabling higher productivity improvement, and such productivity improvement in the second stage is getting reflected on higher exporting intensity. Okay, and then of course we have all kinds of controls. We also included because those who are already exporting, they tend to continue exporting also. So there is that dynamics in there. So we have to consider the lagged exports also in the second stage. And so you can see, as I mentioned earlier, you have all these effects: firm fixed effect, year fixed effect, industry fixed effect, and the state. So depending on where the firm is located, state fixed effect. That is, all these fixed effects are there in the last model. And because here firm fixed effect is difficult to include, and therefore we are taking time averages of each firm variable for each year across firms. Basically, you have one value for all firms in that particular year. Okay, so that's how we take care of this unobserved firm fixed effect. Okay, right. Now, the heterogeneity we are doing, there are two levels of heterogeneity, as I mentioned. One is with regard to debt financing. Other one is with regard to liquidity constraint. Now we find that TFP is more sensitive for firms that have had access to foreign financing and are able to raise higher levels of debt. Okay, but it's less sensitive for firms which are less reliant on debt financing. And clearly, the coefficient is statistically significant. I'll show you here on this table. You can see here, now we have the only difference here compared to the previous table is that we are including this firm level heterogeneity with regard to debt here. And I'm going to talk about the liquidity later. So what we are doing, we are classifying them as financially vulnerable. So firms which are financially vulnerable, they would benefit more from this policy, easing of this policy. Okay, so and that's what we are showing here. So this was the difference in difference coefficient before. Now we are adding here this financial variable, which is debt here. So heavily dependent debt using firms are more likely to benefit from this policy shift. Okay, and that's clearly coming out statistically significant. And we do that for these two models. One, estimate TFP, show that there is TFP improvement, and the TFP improvement in turn is influencing higher export intensity. Okay, so and the other things are, all kinds of interactions are there. Even two-way interaction is there before we go to the three-way interaction. Now, similarly, we look at the liquidity dimension. And with regard to firms, those who are liquidity constrained, or they are in the bottom 25% of the liquidity distribution, those firms we expect that would benefit more from this policy easing. Okay, and because they are able to borrow in foreign currency, and hence that would give rise to an improvement in their productivity and thereby exporting intensity, and which is coming out quite clearly. And those firms, liquidity constrained firms, they're able to increase their export intensity by 1.6 percentage points. And how they're doing it? They're doing it by improvement in productivity. And that's quite statistically significant. As you can see, the first variable, first three-way interaction here. And this TFP and here TFP is predicted values here. TFP is used in the second stage here. It's entering in the second stage. Okay, so now, so basically I showed to begin with, I just showed there is a clear impact of this policy initiative on firm performance in terms of productivity improvement, in terms of exporting performance, right? Now we have to make these results robust. And so we have a range of robustness checks. To begin with, now, as you know, that we have this data from 1988 until 2014. And clearly, you would expect many things would have happened, right? We can't just say it's because of this policy they are better off. So therefore, we have to think about having a uniform time window. In other words, do the same estimation 5 years before the reform, 5 years after the reform. So we have a symmetric time window, and then show that really the policy was effective, even if we have a reduced time window. Okay, so you can clearly see here the same, the result survives exactly, and even if we consider a reduced time window. Okay. Alternatively, one has to think of a different way. You can think of maybe how to control for have some kind of a policy index, right? Because many policies would have changed, right, during this time period. I did a similar exercise in a paper, not on this in this context. The paper published in IMF staff papers in 2008. We had constructed a policy index to, if we want to attribute to one particular policy, we have to control for all other policies that are happening at the same time. So one has to think of having a policy index so that you take care of all other policies, then you can attribute it's because of this policy it happened. Okay, so which we didn't do in this case, but this is one way to establish this result. Second, and this is an important test that people do in this kind of impact evaluation exercise, placebo test for any underlying trend before the intervention took place. Okay, so this policy, this FEMA, it was introduced in Parliament in 97-98 budget. In the government put forward this proposal. So you would expect clearly, probably there was an underlying trend. So you would think maybe the policy did not occur in 2000, maybe it happened before that, right? But here it's about the actual ability or being able to borrow overseas. That can only happen when the law comes into force, right? Until then, even if the information is there, you would still not be able to borrow until you are legally allowed. So what we did is, given that the information was already there, so clearly one would think maybe the policy impact could be visible, starting 97. So we used 97 as a kind of intervention point, as a fake experiment to see whether it had any significant impact if we had taken 97. So having done that, as you will see here, we don't find a significant impact. I mean, you can actually relate it back to that the plot that I showed. Basically, there has been significant increase in borrowing since 2000. Before that, it did not happen. Even people knew this policy is going to be, this reform is going to happen soon, but they didn't know when it's going to happen. In 97, they didn't know when it's going to happen, but they knew it's been already put forward or presented in the parliament. So as you can see here, so there is no underlying trend here. We can say that even if we take 97 as the intervention point, but it had no such statistically significant effect on firm performance, whether we think in terms of TAP improvement or exporting improvement. So now next, there would be, people would also argue that maybe that our treatment group may not be correctly identified, right? So what we did then is that it is possible that this policy applies to firms, those who are in specific industries. Or it's also, one would argue that maybe they are eligible, they can borrow, but they will not borrow. So we would think that, there are so many firms, those who are exporting, and they are eligible to borrow from overseas, but they might not be borrowing because they don't need foreign borrowing, right? So therefore, our identification may not be right. So what we do then, we say, okay, you are eligible, so we change our treatment group. we say you are eligible to borrow and you have used foreign currency borrowing. That's the treatment. Then the control group gets changed here. Control group earlier was the ones who are relying relying on domestic sources of financing. Here, we are now saying the control group, they are eligible to borrow, but they don't borrow. Okay, that becomes our control group. Now, even if we do that, our main idea survives. Okay, main idea is that this policy has been effective in improving performance of these firms in terms of productivity improvement and in terms of exporting intensity. So statistical significant, basically we reproduce the same result, even if we change the treatment group and the control group. Now, next, endogeneity, we test for that because so the only way we can do here is just change the method of estimation, right? It's not a perfect way of doing it, but clearly we are able to overcome because of the method we have used, this impact evaluation method, and that clearly takes care of the endogeneity problem. And we can causally identify that. But in addition, we also used a GMM estimation just to see whether our result survives if we change the method of estimation. Okay, so that is in the same effect we are able to reproduce. Now, this is okay, I have been talking about productivity, right? Productivity, because there are a number of things that could be contributing to productivity improvement. Either your workers are more productive because they are being trained, they are highly skilled. There could be some effort by the company to improve their skills, and or company could be using sophisticated technology. So those are the ways one can be productive. So what we do is, instead of TFP, we try to use, there are two different proxies, or we call them two different channels. Like firms, those who invest something on staff training, they have. So basically, we can identify firms, those who have some information on staff training. And that is one way we try to reflect that productivity improvement, okay? How they would be able to be more productive because they invest in more staff training, okay? And so for those firms for whom we have this information, it takes value 1. Otherwise, basically, no, it takes value 0, right? Similarly, high technology. So basically, technology intensive firms and high technology, low technology. So this classification we do by using a European classification, which is widely used to classify firms into whether it's a high-tech or a low-tech firm, right? So that is how we divide them into these two categories. Then clearly you can see this the TFP improvement that we are seeing is getting reflected through these two channels, staff training and high technology. Okay, now we use these predicted values of these two and then use that in the second stage. Okay, so these are, we can call that as two additional channels through which the productivity improvement could be occurring. Okay, and these two things are basically reflecting that because of this policy initiative, we are able to see improvement in these two things. And those are the channels through which you will have exporting improvement. Okay, so now with regard to financial vulnerability, what I discussed earlier is that we are using only top 25% of the debt distribution, firms in that category, and firms those who are in bottom 25% of the liquidity distribution, right? Now, what we are doing is, now we are changing that to 50th percentile. Okay, so above 50th percentile or below 50th percentile in case of debt, in case of liquidity. In case of debt, it's a above 50th percentile. So even if we change that, there is no, no variation in the result. So the result still survives. Okay. Now we also use alternative definition of this vulnerability. How do we do that? We could actually take firm level performance if they have a high variability, if they have a high volatility of their performance. For firms, we use return on equity is a performance indicator, which is profitability. Everybody knows profitability. If that is highly volatile, then clearly that is a vulnerable firm, right? So we use that information here. And then in place of where we used financial variable like debt and liquidity, we replace that with these three different things. One is the volatility of a return on equity. And second, we also consider size, bigger firms, and collateral, meaning firms those who can pledge some collateral. Not every firm has. So in other words, we look at their fixed assets, not just total assets, but how much of fixed assets they have, which can be pledged as collateral, right? So even if we do all that at a different definition of vulnerability, if we capture by using these three different variables, our result still survives, and result is still robust. So basically, to conclude, we find that that firms with foreign financing, they display higher level of productivity and also exporting intensity relative to firms those who only rely on domestic sources of financing. Okay. And this relationship is more sensitive for firms that enjoy low levels of liquidity and use higher levels of debt financing. So the way we can argue here is that in terms of an implication is that countries that maintain restrictive capital account, they can improve their exporting activity by easing capital controls. And such easing can actually enhance firm level competitive advantage by increasing their productivity and ultimately their exporting and intensity. So I'll stop there and I'll take any questions. I'm sure you'll have many questions, but yeah, let me stop here. Thank you very much for listening.
Thank you, Professor Mallick. So now we can take questions. So we already have two questions. I'd like to request Joita Deshmukh from Presidency University. She has got a question. So Joita, would you please unmute yourself and raise the question?
So is this the question? Yeah, please, yeah.
I have a question to you. You have created a control group and the treatment group based on the status regarding whether they have undertaken external help or the foreign borrowing, whether they use foreign borrowing or not. So did you look at the ownership status of these firms? Because foreign-owned firms have better access of external borrowing.
Okay. This is a good point. This point, no, I don't think we did anything to do with the ownership. But I agree with you that firms, those who are foreign-owned, and clearly they would have better access, right? That's your idea, right? Yeah. Those who have at least some foreign affiliation, clearly they would have better access to international debt market, and therefore, but they don't require. If that is the case, they can. They could have done even before entry. right? If they are foreign-owned firms, they would, sorry, before this policy came into being, right? So they really did not require. If you are foreign-owned already, you have a better access to in that market. But if you are Indian, if you are an Indian firm, locally registered, clearly you don't have that flexibility because you have to go back.
And domestic firms face many constraints regarding this.
Right. Yeah. No, I think we can look at that information because we haven't looked at that. But I agree with you that can be looked at to see what proportion of these firms.
Yes.
Ownership information is not difficult. It's part of the data set. So
I think in the Prof data set.
Yeah, it is there. It is there. But yeah, that's a good point. We'll look at that if we do anything on this topic. Yeah. But thank you for that. Was there anything else you had? Any other point? Okay.
No, not now.
Yeah.
Sorry. Ask you.
Okay, so Zakita had a question. So Zakita, would you please ask the question?
Will you please go back to the earlier slide, please? Where you showed that before FEMA, the two groups of firms are going in the same way. It could be around, I think, slide.
Which slide? Which slide could you say again?
When you showed that there was a graph in which you showed that the firms were going at the same rate before FEMA, the slopes were same.
Oh, this one.
Yeah.
Is it this one? This one or which?
Yeah, the parallel trend assumption.
Yeah. So could you repeat? I didn't get your question.
No, I didn't ask it actually. I wanted to look at the graph. No, it's just a very.
Yeah. It's just before FEMA, and so just to show the parallel trends. I mean, this is like the first thing that we have to do. Sometimes, in this kind of evaluation studies, if you don't satisfy the trends, common trends assumption, it's very hard to go forward with this analysis.
Yeah. What I wanted to ask about this, in the DI, the standard formulation is treatment. Treatment dummy.
Could you please speak a bit louder? I find I don't know. Your voice is not coming through.
In a standard DID formulation, the equation is you take a treatment dummy, you take a FEMA dummy, and then you take the interaction.
Correct. Yeah.
And the interaction gives the DID. But in your model, you have not taken the treatment dummy and FEMA dummy.
No, treatment, those who are using foreign currency. Yeah. So that is a dummy. Yes, you are right. Yeah.
So you are departing from the standard DID formulation. You are not taking the treatment dummy and FEMA dummy separately. You are just taking.
Yes. I see your point. Yeah. I think one can do that. What you are saying, we basically both are dummies, right? So there are different ways actually you can specify. This is one. What you are saying is like take the treatment dummy, then FEMA dummy, then do the interaction. That's one way people do. The alternative way is in DID studies. You can specify the way we have done. There are many papers where they specify like this, right? So, but we have, I see your point. But I think there is, because we have all these fixed effects, it is very difficult. We have all kinds of fixed effects here. And so we have firm fixed effect, we have time fixed effect, and industry. And so if we do what you are suggesting, then these fixed effects would be difficult to include because it will drop out, you see. And so there is that challenge as to how much, what you can include and what you can't. But because these are all dummies, right? Treatment is dummy, and also FEMA is a dummy. It's a time dummy, really.
In fact, one of the participants also made the same comment. Sabine,
yeah.
Would this departure be because of fixed effects?
Fixed effects included.
Yeah, so that's absolutely, because either we can include fixed effects, okay, and then this is how we have to specify, or if we don't include, then of course we can do the way you are suggesting. Okay, because you see, we were asked to by the referee. So this actually, I should give a background. This paper went through 4 rounds of a revision. Like each round was a major revision. So even the 4th round was a rescue one. And so the paper, even the one I presented like 2 years ago, is very different what I presented today. So every time the paper was a different paper, all kinds of estimation. So I think if I go back to my initial version, it is same as what you are suggesting. We did probably that. And then we were asked to include all kinds of controls. So that's why you have all these firm fixed effect, time fixed effect, industry, state. And then even in the second stage also, in Tobit estimator, we are asked to include the unobserved firm fixed effect, which was difficult to do. And the only way it could be done, and that's what the Tobit estimator does. So we just followed the Tobit estimator. And so to use time average for each firm specific variable. Does it help or?
Yeah, thank you very much. I mean, the way you presented, the students and scholars could learn a lot on how to build up a paper.
Yeah, thank you very much. So somebody is saying, could you please unmute? Should I unmute or?
No. What you can do is you can you can stop presenting. In that case, you will be able to see the. If you stop presenting, go to meet and stop presenting.
Oh, if I unmute, then I can hear. Yes. Oh, I see. Okay, I got it. Yeah.
You have to go to meet and.
Professor Mallick.
Yeah.
I have one more clarificatory question to you.
Yeah.
I think there are a lot of evidences of domestically owned firms who are productive and self-selected themselves for export. I think there are evidences. But did this firm later on went for debt financing? Did they go for debt financing later for further for further enhancement in productivity and export promotion?
So you are saying that they may not go for. I mean, they may not continue their borrowing, right? They can. Of course, they will borrow for like a couple of years. Then they can drop out. They'll say, "No, I don't need foreign financing." That's what you mean, definancing, right? Yeah. So no. That is very much there in the data. So not that they are borrowing every year. So probably they need funds now. They want to buy technology. Obviously, they would borrow every year, but they could actually drop out. So the foreign currency borrowing amount could drop to 0 for that firm. Maybe other firms would be borrowing. So what we do is when we try to come up with this treatment, our treatment variable, so whenever we see a firm has this ECB or FCB amount, a positive number, then we say, then we classify that firm into the treatment group. Otherwise, it will not. So, but basically, we say that at any point over this sample period, whether they had any amount of borrowing, foreign currency borrowing, and that's how we classify treatment group. So it is true. You are right. They could have dropped out later on, but they belong to the treatment group. They could, right? So that's how we have done it, and you will find that in the data also.
Okay. Thank you.
Yeah. So once they have borrowed, they become part of treatment group, and then even if they don't borrow, they are still part of the treatment group. But it is possible. You are right. You are right. No, I think maybe it would be interesting to see the firms, those who have exit, or maybe they no longer borrow, maybe to separate
because they
them.
don't need any further finance.
Yes.
Self-reliant.
Yeah. If they no longer borrow, or they don't go back to borrowing overseas, what happens to, maybe they're already more productive firms. That's a good point. We'll look at that. Thank you for that comment. Yeah.
Okay, so any other question?
Yes, I have one. I will request for one clarification only. So the way I measured the vulnerability, the second robust measure is clear to me, but the first one, which is based on the 50th percentile, so would you please clarify that part, how you measure the vulnerability of the firm?
See, we have the two levels of vulnerability. One is debt, other one is liquidity. Suppose you are at the top 25% of, meaning like, somebody, let's say you can borrow like so much, so many billions of rupees, right? So or so many billions of dollars. So if you have reached that limit, or let's think like this, suppose a firm has leverage, say 80%. It's excessively high, 90%, it's excessively high. So that firm is financially vulnerable because that firm will not be able to borrow in a normal, market. People will think like Vijay Mallya, for example, because they were not able to borrow anymore, and that's why he had to leave the country, right? So it's like that. Somebody who is heavily dependent or so much of borrowing, they can no longer borrow, and therefore they are financially vulnerable. But if they are allowed to borrow from overseas, okay, so that gives them some room to be able to borrow. They'll say, okay, I don't have any foreign borrowing, therefore I can. You can say, well, I've never borrowed overseas in overseas currency, so you are allowed. So it basically allows you access to borrow in a foreign currency or external debt market. Second, we look at, some firms are liquidity constraint. They don't have enough cash at their disposal. Okay, so therefore, if they are allowed because of this policy, of course they are allowed. Now, every firm in India, they are allowed to the extent of $750 million today. And they may use it or they may not. But if they have never borrowed, clearly they have that room. They would be able to make a case, yes, I need this money for this purpose. So, but if they are liquidity constrained, they would be more willing to borrow, right? So, and hence, so those financially vulnerable firms would benefit more from this policy initiative, rather than others who are not vulnerable. For them, they have no problem. Maybe they don't rely on foreign borrowing and so on. So that's the result we are showing. And this is an important result, actually. When you have this easing of capital controls, it actually benefits vulnerable firms more than the non-vulnerable firms. So this result is very important. Result which we have highlighted also in this Ideas for India, a kind of non-technical write-up. If people are interested, can take a read also, that one. It's available on Ideas for India website. It's a non-technical version of this paper. So, yeah.
Okay, thank you very much for the clarification.
Yeah, thank you very much. It's very good.
So,
there are interesting.
So, any other question?
So there are quite a lot of people, right? So you had 14. I see here 14 people attended. Yeah, very good. So all are here faculty members, or there are students here?
Mostly faculty members, and there are faculty from outside too. I don't know whether Kumarjit Da is already late or there. So some faculty from other institutes too are there.
Okay.
Some research scholars, some students are there.
Oh, very good, very good. Thank you very much. It was very, very good. I will think about some of these comments, but hopefully, if we have any other substantive idea to do any future research on this topic.
Any other questions or comments, Indra? Kumarjit Da is already there. Kumarjit Da, would you like to add anything or say something?
Yeah, Kumarjit Da, go ahead first. Sushanta, really enjoyed it. Thank you. Really, I'm not an expert.
No, thank you very much for listening, because you waited for like 1.5 hours or maybe.
I had some problems. I was multitasking, so I had to. Anyway, but I really listened to you, and as Zakir said.
So very good. So you will be there for some more time, or you will come back?
Well, I'm still. Well, it is supposed to be. This is my second year. I mean, this calendar year of 2020 is my second year. I started in January 2019. One